So, here's the question we have to ask. Are we witnessing a genuine technological revolution, or are we just living through the biggest, most complex financial bubble in history? That's what this investigation is all about. We're going to dig into the parallels between this AI surge we're seeing right now and the infamous dot-com bubble of 2000. Let's look at the evidence.
Here's how we're going to break it down. First, we'll look at a crack in the foundation, the first sign that something might be off. Then, we're going to open up the cold case file on the dot-com crash to see if history is repeating itself. We'll follow the money, and we're talking a $500 billion bet, and check in with a fear index that's tracking all this market anxiety. Then we'll look at the immediate threat of a market correction, and finally, we'll ask the biggest question of all. If this whole thing goes south, who really pays the price?
You know, every investigation has a starting point. And for us, it doesn't start with the hype around some new AI model. No, it starts with a quiet little warning sign coming from one of the old giants of the industry.
Yeah, sometimes the first clue that something's not quite right doesn't come from some flashy startup. It comes from the moves that the established players are forced to make just to keep up. And Oracle's recent activity? Well, it's our first piece of evidence that the ground underneath this whole AI boom might not be as solid as it looks.
Okay, so what Oracle is doing here is really telling. To get in on this AI arms race, they're making a massive bet, and they're funding it with debt. They're actually choosing to have negative free cash flow, meaning they're spending more money than they make just to build out their AI systems. And you know who's noticing? The credit markets. Their bonds are now rated just one step above junk status. And get this, the market is pricing in an 8% chance that Oracle could default in the next 5 years. For a giant like Oracle, that is a huge red flag. It's the first crack in the facade.
So that one crack, it leads us right to the heart of the matter. It's time to reopen the cold case file on the year 2000 and the dot-com crash, because the question isn't really if there are parallels anymore, it's about how deep they actually run.
The stories just sound so similar, don't they? Back in 2000, the narrative was, the internet changes everything. Profits? That was an afterthought. It was all about getting eyeballs. Fast forward to today, and the story is that generative AI will revolutionize everything. But just like back then, the same questions are starting to pop up. Can this technology actually make enough money to justify these insane valuations? Is there a dangerous gap between the hype and the actual revenue?
And this is where it gets really interesting. Let's look at the hard numbers. First up, valuations. In 2000, the Nasdaq was trading at a crazy 60 times forward earnings. Today, the S&P 500 is around 23 times. High, for sure, but not in the same universe. But now look at the venture capital funding. Last year, AI startups alone pulled in over $258 billion. That's more than double the entire US VC market at the peak of the dot-com bubble. And, just like back then, a huge chunk of these new AI unicorns, we're talking around 70%, are deeply unprofitable. They're just burning cash to grow.
So here's the key takeaway. While the whole market isn't as nuts as it was in 2000 based on earnings, the sheer amount of money being poured into just one sector, AI, is something we've never seen before. The risk isn't a carbon copy of 2000. It's a new kind of bubble, one with even more cash focused on just a few big players. It's a different beast, but it's still a beast. Which brings us to our next step. We're going to follow the money. Because to really understand the scale of this AI boom, you have to look at the staggering amount of capital being spent just to build its foundation.
According to Goldman Sachs, the consensus is that capital expenditure, or CapEx, on AI is going to hit $527 billion in 2026. Now, what's wild is that for the last 2 years, analysts have underestimated this spending growth by over 50%. So this number, as big as it is, might actually be on the low side. In fact, some people think that number could be closer to $700 billion, again, in a single year. To put that in perspective, that's more than the entire yearly economic output of countries like Switzerland or Argentina. This isn't just an investment anymore, it's practically its own economic force.
This all leads to a crucial concept, infrastructure overspend. It's a fancy way of saying you're building a massive, beautiful cathedral when you only have enough people to fill a small chapel. The core risk is this huge gap between valuation and revenue. Research from MIT found that even with tens of billions invested in enterprise AI, 95% of companies are getting zero return. The money's definitely being spent, but the profits just haven't shown up yet.
Okay, so as we dig deeper, the warning signs start popping up everywhere. We're moving beyond just the numbers on a balance sheet and into how the market is feeling.
And right now, fear is becoming a pretty good indicator. When Jamie Dimon, the CEO of JP Morgan Chase, America's biggest bank, comes out and says people are doing dumb things, he's talking about speculative AI investments. That's not just an opinion. That's testimony from someone at the absolute center of the financial world. It's a clear signal that there's a growing worry that easy money is just chasing hype instead of solid fundamentals.
And this anxiety, well, it's actually being tracked. The AI CERT's Market Fear Index boils it down to three big concerns. First, that debt-fueled spending we talked about. The hyperscalers, the big cloud computing giants, sold $121 billion in bonds last year just to fund this expansion. Second, there's this fear of a SaaS-pocalypse, the idea that new AI agents, AI that can act on its own, could just wipe out the business models of hundreds of software companies. And third, concentration risk. The top 10 stocks in the S&P 500 now make up over 40% of the whole index, which just multiplies the risk for everyone.
And that brings us right up to today, to the most immediate, tangible threat that's on the horizon, a major market correction.
The language you're hearing from market analysts is getting pretty serious. The general feeling is that the NASDAQ 100, where all the biggest tech names live, is entering a much riskier phase. The risk of a serious pullback is growing every single day. So what would actually trigger a correction? Well, analysts don't think it'll be some big economic event. They think it's going to be about earnings. The moment those sky-high AI profit expectations meet reality. Now, the most likely outcome is a 5 to 10% pullback, which is pretty normal. But, and this is a big but, there is a very real risk of a much deeper 10 to 20% correction if those companies disappoint on their earnings. And because the whole market is so reliant on just a handful of giant companies, if one of them stumbles, it could take everybody else down with them.
So, this is it. The final and honestly the most important part of our investigation. If all these warnings are right, if the bubble does burst, what happens next? What's the fallout? And who's left holding the bag?
And let's be perfectly clear about this. A major market correction is never just a Wall Street problem. It doesn't stay in Manhattan. It ripples out. It hits retirement accounts. It crushes consumer confidence. It impacts hiring. It affects the entire economy. It has real, painful consequences for real people. Which brings us to our last question. We've laid out all the evidence. The echoes of 2000, the unprecedented spending, the growing fear, and the very real risk of a correction. A shockwave from a market this top-heavy won't be contained to Wall Street. With market concentration at a 50-year high and so much of our economy tied to this AI surge, the ultimate question isn't just if the market will correct, but who is left exposed when it does.